Ever wondered how financial experts decide which stocks to invest in? What's the secret behind their choices? Well, it all boils down to the art of stock evaluation. This critical process is more than just picking the most popular stocks or following market trends. It's about making informed decisions based on a detailed analysis of a company and its financial health. Think of it as a health checkup, but for a company. Just as doctors look at various health parameters before diagnosing a patient, investors examine various financial metrics to assess the health of a company. It involves delving deep into the company's financial statements, understanding its revenue streams, assessing its debt levels, and even scrutinizing its management. So, why is this process so important? Simply put, it helps investors minimize risk and maximize returns. It provides a clear picture of whether a company is overvalued or undervalued, guiding investment decisions. Stick around to uncover the step-by-step process of stock evaluation. Before diving into the details, let's understand the basics of stock evaluation. Stock evaluation is much like trying to solve a puzzle. It's the process of determining the intrinsic value of a stock to find out whether it's overvalued, undervalued, or fairly priced. So why is this important? Well, just like you wouldn't buy a car without knowing its worth, it's crucial to know the value of a stock before investing in it. An informed decision can mean the difference between making a profit and losing your investment. It's about avoiding risks and maximizing returns. Now, there are two primary methods to evaluate stocks: fundamental analysis and technical analysis. These methods are the tools that investors use to make sense of the stock market's chaotic world. Fundamental analysis is a method that involves evaluating a company's financials, industry position, and market conditions. It's about understanding the company's health and its potential for growth. You're looking under the hood, so to speak, examining everything from revenue and earnings to management and competition. On the other hand, technical analysis is like forecasting the weather. It involves studying statistical trends gathered from trading activity, such as price movement and volume. Instead of asking, "What's the company's value?" technical analysts ask, "What's the market's perception of this company's value?" It's much more about patterns, charts, and trends. Each method has its strengths and weaknesses, and often they're used in tandem to provide a more complete picture. Some investors may lean more towards fundamental analysis, while others might swear by technical analysis. But at the end of the day, both methods aim to help investors make more informed decisions. Now that you know what stock evaluation is and why it's important, it's time to delve into the details. First up, let's explore the world of fundamental analysis. Fundamental analysis is like the detective work of investing. It's about delving deep into a company's financial health, industry position, and the overall market conditions. You could say it's like peeling back the layers of an onion, revealing the core of a company's financial strength or weakness. At the heart of fundamental analysis are the financial statements. These include the balance sheet, income statement, and cash flow statement. Through these documents, we can dissect a company's earnings, debt, and profit margins. Earnings are the profits a company makes, and they're the primary measure of its financial success. Debt represents the obligations the company has to pay back. A company with too much debt may be seen as risky. Profit margins, on the other hand, tell us how much of the revenue is kept as profit after all expenses are paid. But fundamental analysis goes beyond just numbers. It also looks at the company's position within its industry. Is it a leader, or is it trailing behind its competitors? What's the size of the market it operates in, and how much room is there for growth? The market conditions also play a crucial role. Is the economy growing or shrinking? Are there any major events that could impact the company's performance? By taking all of these factors into account, fundamental analysis helps investors gauge a company's intrinsic value. This is the true value of a stock, irrespective of its current market price. It's like the North Star for investors, guiding their investment decisions. However, as comprehensive as it may be, fundamental analysis isn't the be-all and end-all. It's a powerful tool, yes, but it doesn't guarantee success. Market prices are influenced by a multitude of factors, many of which are unpredictable. Fundamental analysis provides a clear picture of a company's current status and potential growth, but it's just one piece of the puzzle. Now, onto the second method of stock evaluation, technical analysis. Technical analysis is a method that focuses on statistical trends derived from trading activity. Think of it as a way to decode the language of the market. By observing and interpreting these trends, investors can make educated guesses about a stock's future price movements. At the heart of technical analysis lies the principle that price movements are not random, but are influenced by various factors, including economic indicators, company news, and market sentiment. These factors create patterns that can be studied and used to predict future price movements. One of the key elements of technical analysis is price movements. Analysts closely monitor these movements as they can indicate market sentiment. For example, if a stock's price is consistently rising, it suggests a bullish sentiment, meaning investors are optimistic about the stock's future. Conversely, if the price is consistently falling, it suggests a bearish sentiment, indicating pessimism about the stock's future. Another important element is trading volumes. Trading volumes give us an idea of the strength behind price movements. If a stock's price is rising and the trading volume is high, it's a strong indicator that the price may continue to rise. On the other hand, if the price is falling and the trading volume is high, it could signal a potential price drop. Then there are chart patterns. These are graphical representations of price movements that have been observed to repeat over time. They can be as simple as a line chart or as complex as a candlestick chart. By studying these patterns, analysts can predict potential price movements and make investment decisions accordingly. Technical analysis, however, isn't foolproof. Like any method, it has its limitations and should not be used in isolation. It's most effective when used in conjunction with fundamental analysis, which focuses on a company's financial health and market position. Technical analysis gives an insight into market psychology and future price movements. Combining it with fundamental analysis gives a comprehensive view of a stock's value. Now that we understand the two main methods, let's talk about the step-by-step process of stock evaluation. The first step in the stock evaluation process is company research. This involves understanding the company's business model, its products or services, its market position, and its competitive advantages. You should also consider the company's leadership, its strategic direction, and any potential risks it faces. Next, we delve into financial analysis. This includes reviewing the company's financial statements, the income statement, balance sheet, and cash flow statement. Look for trends in revenue, profit margins, and earnings per share. It's also important to evaluate the company's financial health by examining its debt levels, liquidity, and return on equity. Our third step is market analysis. This involves looking at the overall health of the market and the specific industry the company operates in. What are the market trends? How does the company compare to its competitors? A useful tool here is the price-to-earnings ratio, or PE ratio, which can help you assess if a stock is over or underpriced compared to its peers. Finally, after all this research and analysis, we make an investment decision. But this decision isn't just about whether to buy or not. It's also about how much to invest, when to invest, and when to potentially sell. These decisions should be guided by your overall investment strategy, risk tolerance, and financial goals. Stock evaluation is a complex, multi-step process that requires time, effort, and a keen understanding of business and finance. But with practice and patience, it can become a valuable tool in your investment toolkit. Remember, stock evaluation is not a one-size-fits-all process. It requires a diligent and personalized approach. So, we've covered a lot of ground in our journey to understand stock evaluation. Indeed, we have. We opened up with the art of stock evaluation, laying the foundation by discussing the basics. We delved into understanding the intrinsic value of a stock, how market conditions, company performance, and other factors influence this value. We then ventured into the world of fundamental analysis, where we explored how a company's financial health, industry position, and economic factors play a crucial role in determining a stock's worth. From there, we transitioned into technical analysis, highlighting the importance of studying market trends, price patterns, and volume data to forecast future price movements. Finally, we wrapped up by going through the step-by-step process of stock evaluation, underscoring the need to combine both fundamental and technical analysis for a comprehensive assessment. With these tools in your arsenal, you're well on your way to making informed and profitable investment decisions. Happy investing!